Interest rates are kind of almost at their all-time low. They backed up a little bit in the last couple of weeks, but generally they're very low. The banks are now 5 or 6 years or 4 or 5 years out of the credit crisis. The regulations, while they're not fully done, they're much further down the road. The question now becomes, are we seeing risk come back into the investment and banking industry? I'm sitting here with Laurence Wormald, head of research at APT, a SunGard company. They handle and do a lot in the risk management space. Laurence, welcome.
Thank you.
And I guess the first question is, you focus on investment management risk. Are we seeing customers start talking about, using some of this cash or moving it out of sovereign debt, or actually doing something more than, sticking it in their mattress?
Oh, absolutely. And since the beginning of the year, the rise in the equities markets has been a sure sign that all that liquidity provided by central banks is not just under the mattress. Corporates have seen high levels of profitability as the funding is so cheap. However, the concern now is looking forward towards the tapering off of some of that quantitative easing, and when that happens, we won't be able to sit on a safe asset like a treasury and imagine that our capital is going to be preserved. So a new thinking about risk has to emerge at that point.
So how are investors starting to think about this? Certainly they're investing more in risk management, understanding it. The regulators are certainly forcing them that way, but are they starting to look at trying to put more capital to work, look at new structures, look at new geographies? How are they looking to use some of this capital?
Yeah, they are looking to diversify effectively in ways that perhaps they didn't do before. So that means globally and also across lots of asset classes. So we're seeing a lot of interest among our clients who are institutional fund managers, asset owners like pension funds and sovereign wealth funds, as well as hedge funds, looking at less liquid asset classes. Private equity, direct real estate, infrastructure has become very popular among asset allocators, alongside equities, credit default swap markets. The feeling is that you're not going to make money in highly rated bonds in the next few years, so we must be looking elsewhere, but we must be putting money there in such a way as to diversify properly and looking at models which can help them do that. So the money flow is definitely starting to move away from the so-called safe bonds, but it's not going directly just to equities. Clearly there's nervousness about the levels of some equities markets. We saw that in the last 2 or 3 weeks, and so the emphasis is on more risk but more diversification at the same time.
So how certainly when we think about risk, when we think about financial markets, we think about equities, we think about sovereign, we think about CDS and credit and all this, all the things that we eat and breathe all the time. When you start looking at really wide diversity of asset classes and into real estate and into other types of assets, how are firms managing that risk? You don't typically think of looking at a Bloomberg or Reuters terminal and getting a mark to market on a building, or certainly REITs, I guess, are a little bit more transparent. But how are they starting to analyze all these assets from all over the geographies?
That's a real challenge. We've learned that liquidity itself carries extra risk. So firms are having to assess very carefully the characteristics of these less liquid and unlisted assets. But there are techniques that are now being incorporated into some of the risk models which we provide, which allow you to capture alongside the risks in conventional markets and the so-called market indicators, credit spreads, equity markets, FX markets. The concept of public markets equivalent is actually what the economists call it, and we've drawn on that to help people think about the risk equivalent of these less liquid asset classes. So there's a lot of interest in that, especially among the asset allocators who are searching, as you've said, for yield in a world where it doesn't look like you're going to get the yield from AAA rated bonds anymore.
So you take something that may not necessarily be so liquid and then look for some sort of surrogate that may be more liquid and more be able to be priced and kind of use that.
The idea of public markets equivalent is quite simple, is that private equity shares its risks with public equity. Property, you can characterize the risk on property in terms of some public markets assets. You've mentioned
Like
REITs, but also property companies, which are themselves listed. And if you can capture the co-movement of these different kinds of listed assets, together with the cash flows that are associated, as we all know, with a funding vehicle for an unlisted asset, you get some handle on the risk of that unlisted asset were you to bring it to market.
Interesting. The other thing we were talking about a little bit before, you mentioned you just came from a whirlwind around the world tour, is that we're starting to see innovation in a couple of areas and geographies that we really haven't, seen that much innovation before. You mentioned China. You also, mentioned, to a certain extent, we're seeing a revivement of Japan.
Yes,
talk to me about the Shanghai
well,
experience.
I wasn't so much surprised about what's going on in Japan, because clearly there's a big political push and it's been so widely written about. But what surprised me was a meeting I had with one of our big clients, a broker-dealer in Shanghai, who straight out, head of risk there, straight out asked me, Laurence, does SunGard model Chinese CDOs? I said I didn't think there were any CDOs in China, and he said no, but there soon will be, because we're going to create them. And then he went on to say that because of the new top-down party conference where they wanted to rebalance the economy now away from export manufacturing towards services and domestic consumption, they see deregulation of the financial industry and innovation within the financial industry as actually part of that very big rebalancing of their economy. So the implication is that there'll be more complex products and even Chinese CDOs soon appearing in the marketplace, because the regulators are being told, don't get in the way of this kind of innovation in China. So that's a challenge for all of us.
That sounds exciting, but a little scary. I don't know.
We carried on the discussion, and I said, you're well aware of how toxic these products became in 2008 and 2009 in the US and now in Europe as well. And again, he said, yes, we're well aware of that. We think we have to be smarter. So anyone getting involved in these Asian markets will find now complex products where perhaps you wouldn't have expected those to be coming back, but it is part of the rebalancing of China's economy. Interesting.
So, do we think that this risk-on trade, is coming back? Or are we starting to see, investors actually think a little bit more about risk? Are we starting to see that this low yield curve is pushing people into more complex products, looking for yield?
Undoubtedly, but if they're doing that the smart way, then they're doing it with a full awareness of the kinds of scenarios which could unfold if the liquidity dries up a little bit, if there's an unwinding of all the central bank liquidity flows.
When you talk about managing risk, we talked a little earlier about, you look at it kind of in three ways in terms of scenarios. Why don't you kind of talk about the three major aspects you look at trying to help your clients manage risk on a holistic basis?
Yeah, the first thing is to get the headline number right and to have a robust process where you're integrating across all these asset classes. So not having one model for stocks, another model for bonds, a third for commodities, but rather one model which captures the co-movement of all those asset classes. Then you want to be thinking about the downside simulation, part of the distribution, in other words, focusing on risk in the tail. And the way you really get at risk in the tail, because we don't generally get penalized for outperformance, but we get penalized, and it can be a career limiting thing to underperform for too long, is to focus on the scenarios that actually drive shocks in the marketplace. So scenario analysis was one thing we didn't do so well before the financial crisis. Probably the scenarios we thought about were too glib, not
tame.
Challenging enough, as you said, too tame. So now we're helping our clients think about plausible scenarios which really do have significant downside impact. So focusing on the tail, perhaps through techniques such as reverse stress testing.
Reverse stress testing. Well, what is a reverse stress test?
It's a simple idea, really.
Does that mean I just go off and party or something?
We turn the question around. So the normal question is, under this scenario, how much would it hurt me? Turn the question around and simply say, what would hurt me the most.
Okay, so
I've
really
got a
looking-
portfolio. I know what I'm holding today. What would hurt me the most? So what plausible combination of shocks would actually cause me severe distress, say
So
at
if
the,
I'm
at the
overweighted-
20%, the 30% or the 40% loss level?
So if I'm overweighted China, tremendous devaluation in the yuan or something like that, or, if I'm have a lot of, long-term debt, backup of so many basis points on the yield curve or something in the high end.
Yeah,
or,
but the key to doing this right, of course, we can all think of scenarios where the market falls by a large amount and we lose a lot of money. But the key is to do it in a macro, consistent framework, so that you actually think of the realistic combination of events and the realistic set of correlations associated with those. So some regulators are actually mandating banks in Europe, for example, to think about reverse stress testing. It's not something that's widely done in the asset management industry. We think there should probably be more of that done.
Now, if you start thinking about that and trying to put plausible scenarios together, I assume that's what you guys kind of do and start theorizing with clients about how to put that together.
Yeah, I spend a lot of my time talking to clients, investment people and risk people in the businesses that we work with, thinking about how to combine a factor view of the world, because we think that there are these driving forces, interest rates, policy, FX rates, credit spreads. These are the things we can observe in the market that drive the prices of lots of assets, but also understanding that there is a simulation of different scenarios into the future, and we need to think about not just the most obvious one, but the tails of that distribution. And so the discussions are around what could drive us into the tail. And I think that's what really good risk management is about. It's not just about saying my VAR's gone up by 1% or 2%. It's about what's causing me to see the kind of shocks that could drive my returns into that downside.
Interesting. With that, I want to thank Laurence Wormald, Head of Research from APT, a SunGard company, talking about risk on and how we manage risk as a global asset manager. Thanks a lot for joining me.
Thanks for the opportunity. Bye.
Thank you.